Well, greetings everyone and welcome to the Argonaut monthly video covering September 2025 and the first few days of October. Now, as always, you can read about the performance of the two Argonaut funds in our monthly fact sheets available on the award-winning Argonaut website. Now, the most significant event of the month was the Federal Reserve's first interest rate cut since November 2024, justified by recent data showing significant downward revisions to job creation. Although Chairman Powell emphasized the risk management nature of the cut, the interest rate future market now expects further 25 basis point cuts in both October and December. Now, it was also a great month for diplomacy. President Trump spent 2 days at Windsor Castle on a state visit, his second, displaying a love for Britain and its history that certainly seemed to exceed that of the current UK Prime Minister. Trump then visited the United Nations General Assembly, and after the escalator mysteriously broke down as Trump entered the building, he gave them some home truths about immigration and net zero. And finally, at the Ryder Cup in Bethpage, New York, European golfer Rory McIlroy told the American crowd exactly what he thought of them. Now, during the month in France, the government of Prime Minister Bayrou collapsed following a vote of no confidence driven by opposition to unpopular austerity proposals. Now, France currently has the biggest budget deficit in the EU at 5.8%, and although its debt to GDP ratio overall is below Italy and Greece, unlike Italy and Greece, France currently runs a primary deficit rather than Italy and Greece that run primary surpluses. So, i.e., Italy and Greece actually balance the books before interest payments, whereas France doesn't. So this is why financial markets are worried about the path of debt sustainability in France. They're simply spending too much money, and they already have the highest taxes in Europe as well. Now, the new Prime Minister has distanced himself from his predecessor's cost-cutting plan, proclaiming he will seek out a consensus around the revised budget. Now, this seems to us very unlikely to tackle out-of-control spending on pensions, welfare, and healthcare. Now, to convince financial markets of their debt sustainability, both the UK and France, currently the two sickest men in Europe, need to turn these primary deficits into a primary surplus, as the UK did certainly for most of the 1980s and 1990s when it was last governed responsibly. And they need to do this without impacting economic growth. So, in my view, this can only come from allocating less resources to the unproductive through state spending. Now, I'm sure we'll return to this subject later in the year with the autumn budget in the UK. Now, we talked last month about the Danish offshore wind farm developer Ørsted and its $9.6 billion rescue rights issue. Now, in our experience, there are 3 types of equity rights issues that investors should consider. The first is a good business needing to raise capital to accelerate growth. This can be a good investment. The second are good companies needing to fix bad balance sheets. Again, this can be a good entry point for investors. The third, bad companies that will always have bad business models that want to extend liquidity and pretend that their business model works. Now, whereas the first 2 examples can make good investments, the third will always be a disaster. Investors are simply throwing good money after bad. So we believe that the Ørsted rights issue is an example of the third type of rights issue. Now, during the month, Ørsted won a preliminary injunction allowing them to continue work on their 50% owned Revolution offshore wind project that was being built on federal seabed and opposed by President Trump. During the month, President Trump, during his address to the United Nations General Assembly, warned delegates,
"They're a joke. They don't work. They're too expensive. They're not strong enough to fire up the plants that you need to make your country great. The wind doesn't blow. Those big windmills are so pathetic and so bad, so expensive to operate. And they have to be rebuilt all the time. And they start to rust and rot. Most expensive energy ever conceived. And it's actually energy. You're supposed to make money with energy, not lose money. You lose money, the governments have to subsidize. You can't put them out without massive subsidies. If you don't get away from this green scam, your country is going to fail."
Now, we thought it might be interesting to examine the economics of this particular Revolution offshore wind project and to actually see how much it's costing and also what returns investors are making. Now, although wind enthusiasts have previously claimed that wind was the cheapest form of energy, it's strange that these offshore wind projects never get built without massive subsidies that the electricity consumer ends up paying. Now, on Revolution, Ørsted will receive two kinds of subsidy. The first is a tax credit for the investment. So upon completion of the $6.3 billion project, Ørsted will receive a tax credit subsidy of nearly $1 billion for 30% of their $3 billion investment. Now, there's also an additional subsidy, a bigger subsidy, because the project will also have a 20-year power purchase agreement, a PPA, with Rhode Island and Connecticut at $100 per megawatt hour. So this is the states forcing local utilities to buy electricity from the Revolution project at a fixed price of $100 per megawatt hour. Now, this compares to an average electricity price in these two states last year of just $27, so nearly 4 times higher than the market price. And we estimate this annual subsidy to be worth over $4 billion in additional electricity bills over 20 years, of which Ørsted will receive $2 billion or $204 million annually to Revolution and $102 million to Ørsted. So over the lifetime of the project, this means a total of $2.9 billion of subsidies compared to $3.4 billion invested by Ørsted. Now, you would think that despite Ørsted getting nearly $1 of subsidies for almost every dollar of its own money it has spent, that the project would be super profitable. But you would be wrong. Ørsted has suggested that the 50% stake in the project will generate them just $157 million of EBITDA annually, and excluding the tax rebate, we calculate this to be $110 million. So remember, this compares with $3.4 billion invested by Ørsted, nearly $1 billion of tax rebates, and $2 billion of revenue subsidies to Ørsted. So for Ørsted shareholders, this implies an anemic annual return on invested capital of just 4.5% or 3.3%, excluding tax credits. So if you like, a return-free risk for Ørsted's investors, but including all subsidies, the annual return on invested capital for the project and the US economy falls to minus 0.2%. So this calculation, which we believe is an illustration of the generic economics of offshore wind, demonstrates how offshore wind rips off both consumers and investors and has a detrimental impact on the overall economy as finite resources are squandered to appease a political movement, net zero, that looks and behaves like an apocalyptic cult. It is a type of indulgent capital allocation that communist economies do at scale before they fail. Now, if you are registered as an Argonaut client on the award-winning Argonaut website, we've got a special treat for you in that you will be able to read more about this over the coming weeks. So we're excited about what's going on in global energy markets. OPEC Plus, which currently produces around 42 million barrels of oil a day against global demand of about 104 million barrels a day, is expected to increase its crude product quotas again on October the 5th. Now, having cut crude production by 2.2 million barrels a day in 2023, from April 2025 this year, OPEC began increasing its production again, with cumulative increases of 2.6 million barrels so far this year. So it's taken back all of the previous cut from 2023. Now, we believe that in contrast with the type of negative engagement witnessed with the Biden administration, Saudi Arabia is willing to work closely with President Trump to reduce the price of oil insofar as it reduces US inflation, but it also puts pressure on Russian public finances, which may inhibit Russia's ability to fund its Ukraine war. Now, we also note that Mohammed bin Salman, MBS, is due to meet President Trump in Washington in November. Now, this increase in OPEC production will, of course, mean lower oils, not necessarily that good for the energy sector as a whole, but within the energy sector, there are parts of it that will benefit from this. One might be oil companies with refining capacity, but we think that the best way to play this is investing in oil tankers, because OPEC increasing its production will be a boon for the tanker market, and in particular the type of very large crude carriers, VLCCs, that dominate the Arabian Gulf trade. Now, spot rates in this market have risen by 50% over the last month and are currently trading at a 2.5-year high, despite September usually being the seasonal low. And this will also lift the refined product market, since it lessens the appetite for owners of dirty tankers to wash out their tanks and cannibalize the clean product market. Now, this tanker trade is also driven by what's going on in Russia, and indeed what's going on with OPEC Plus may have a significant effect on the Russia-Ukraine war. So before 2022, Russia was exporting 4.5 million barrels a day of crude, so that's out of about 9.5 that it produces, and 2.9 million barrels equivalent of refined product, most of which went to Europe. Now, Europe still imports 20% of its annual diesel demand, which, following its sanctions and termination of Russian imports, it must source from further afield, which of course means more demand for ships. Now, despite it being the third year of the conflict, EU countries continue to import Russian oil via the Druzhba pipeline, so that's Hungary and Slovakia, and LNG by ship into France, the Netherlands and Belgium. And President Trump has identified this trade as an impediment to the imposition of further secondary sanctions on Russian energy exports. But since May 2025, Ukrainian drones have targeted Russian oil refineries, and these attacks, described by President Zelensky as the most effective sanctions, are estimated to have destroyed, or at least temporarily impaired, some 20 to 40% of Russian refining capacity. Now, owing to domestic shortages, Russia has now banned all gasoline and some diesel exports, but is instead exporting more crude, which, in view of some Indian refineries reducing their demand, now needs to go elsewhere, possibly to China, which is both building inventory and has some spare refining capacity. Now, although Russia is still producing in line with its OPEC plus quota capacity of 9.3 million barrels a day, with storage capacity in Russia full and refining capacity impaired, Russia may now need to cut back on crude exports if it can't source enough ships for its shadow fleet. Now, some 20% of global crude oil production is currently sanctioned, so that's Russia, that's Iran, that's Venezuela, and as more dark fleet vessels are blacklisted by sanctions, this increases Russian demand for new and as yet unsanctioned vessels to go over to the dark side. Normally these are older, so over 90% of the shadow fleet is 15 plus years. These are mid-sized ships, so Aframaxes and Suezmax rather than VLCCs that can take cargoes from Russian Baltic ports, Primorsk and Ust-Luga, and of Novorossiysk in the Black Sea, simply because these ports can't accommodate VLCCs due to berth depth and mooring constraints. So roughly 1/3 of all tankers globally are now engaged in the shadow fleet, with Russia accounting for 2/3 of this trade. And as more of this dark fleet is blacklisted, there's not a limitless supply of regular ships to replace them. So this is putting pressure on rates, shipping rates, tanker rates in general, and the quoted companies that of course don't have exposure to the dark fleet, they're making more money out of this because their assets have become more scarce. Now, diesel inventories, which are low globally but are particularly low in Europe, which continues to shut its own refining capacity, so we've lost another 3% so far this year. And whilst we're currently at the seasonal low in demand for crude owing to refining maintenance and demand increasing over the winter, Europe will need to import significantly more refined product from further afield over the coming months, with fewer regular product tankers on the market. But these dynamics are also placing economic pressure on Russia to end the Ukraine war. So officially, Russian defense spending has climbed to 32% of the federal budget from 15% in 2021 or 8% of GDP. But Putin has also leaned on Russian state banks to lend recklessly to the defense sector, meaning that not only will these Russian banks need to be recapitalized, but that official figures on Russian defense spending may underestimate it by between 150 and 200%. Now, with taxes on oil and gas in Russia covering just a quarter of state spending this year from 30% last year, Putin has recently been forced to increase VAT from 20 to 22%. And these higher taxes and fuel shortages are likely to increase popular resentment against the war. But all of this, to recap, creates a very strong fundamental trade in both crude and product tankers over the foreseeable future, hence why the tanker trade is currently our highest conviction position.